Hello and welcome. For decades, we've been handed this one single playbook for retirement. Well, today, we're going to tear that playbook apart. We're going to deconstruct the whole idea of the 401k and explore a completely different way to think about your financial future, all based on our source material. So let's start by questioning the very foundation of how we've all been taught to save.
So let me just start with a question that gets right to the heart of it. Is your retirement plan really a plan, or is it just hope? Because according to our source material, for most people, it's just that, hope. And frankly, that's dangerous. It's kind of like playing the lottery. Yeah, sure, it's possible you'll win, but is it a strategy? When you have zero control, all you can do is cross your fingers and hope it all works out. I mean, we all know this script, right? We've heard it a million times. Put your money in a 401k, diversify, don't put all your eggs in one basket, and then just sit back and wait for the long term to do its magic. For millions of us, this is the entire foundation of our financial future. But what if that foundation is cracked?
Right, so we're told to trust the long term. But what does that even mean? Think about it. If you're, say, 40 years old, a 30-year long-term plan takes you to 70. That's your entire retirement window. The whole thing is built on this one massive assumption that over those 30 years, the market is just going to go up. But what if it doesn't? This quote from our source material is just wow. It's so powerful because it points to a real-world, modern example that completely shatters that long-term always goes up idea. The author makes a chilling point. The U.S. has followed a pretty similar economic path to Japan. A huge housing boom, then a bust, and then the government trying to print money to fix it. So the question is, why on earth should we expect a different result?
Let's really soak this in for a second. Imagine it's the mid-'80s in Japan. You're 50 years old, planning to retire in about 20 years. You're watching the market just explode, quadrupling in value. You're feeling fantastic. Then, the crash of '89 hits, and for the next 20, even 30 years, your entire retirement window, your so-called diversified portfolio goes absolutely nowhere. It's a disaster. And it just blows up the simple advice to wait for the long term.
Okay, so here's a super important concept. Understanding what diversification actually protects you from. It protects you from non-systemic risk. That's when one company, like Enron, just completely implodes. But our source has this brilliant analogy. It's like a flu shot. A flu shot is great for protecting you against the flu, but it does absolutely nothing to protect you from cancer or a heart attack. Well, diversification is the same. It protects you from one thing, but it does nothing, literally nothing, to protect you from systemic risk. That's when the whole boat is sinking. It doesn't matter where your deck chair is.
And if you think, oh, that can't happen here, think again. During the tech bubble burst, the NASDAQ, a huge diversified index, lost 85% of its value. 85%. Can you imagine your retirement account taking an 85% haircut? That is systemic risk in action. It didn't matter if you owned 100 different tech stocks, the entire system, the whole sector just cratered. And this brings us to a memory that's probably still pretty painful for a lot of people. The 2008 crash. So many 401ks were just decimated. And the source material nails exactly why. They were built on one thing, and one thing only, the hope for capital gains. The hope that the price of your stocks would go up. There was no actual income, no cash flow. So when the market value collapsed, people's net worth just evaporated. So this really lays out the two different philosophies here. The 401k path, that's the path of hope. It's totally passive, you put your money in and just pray the market cooperates. You have basically no control. But the alternative, the builder's path, is all about strategy. It's an active approach where you take control and you focus on something totally different, generating predictable cash flow.
So if that passive path is based on hope, what's the active one look like? Well, the source material lays out a builder's framework. It's a set of 4 core principles designed to actually give you control over your own financial destiny.
And this whole framework is built on what our source calls the 4 pillars of investing. Each one of these pillars is a different skill, a different way of looking at the world. And the idea is you need all 4 to build something that's actually going to last. So let's break down how you build this thing pillar by pillar. Okay, pillar 1, fundamental analysis. This is all about seeing the big picture. And the source gives us this really simple but powerful formula. Policy plus demographics equals the future. So think about it. We have a government policy, Social Security, that pays people over a certain age, and we have a demographic, the baby boomers all moving towards that age.
You put those two fundamentals together, and you can predict with pretty high certainty that there's going to be massive government spending in the future.
Pillar 2 is technical analysis. Now, this isn't about the why, it's all about the what. It's looking at charts, at data, and just identifying trends. The source uses this absolutely hilarious analogy. It's like watching an old episode of Seinfeld. You know exactly how Jerry's love life is going to play out. He meets a girl, things are going great, and then he finds some tiny, insignificant flaw, and the whole thing blows up. Markets have predictable patterns too, and technical analysis is just about learning to see them.
Next up, pillar 3, cash flow. And folks, this is the engine of the entire strategy. This is not about your account value going up on a statement. This is about your assets putting real, spendable cash in your pocket month after month. The goal is so simple and so powerful. Make your passive income greater than your expenses. The moment you hit that crossover point, you are financially free. Period.
And finally, we get to what the source calls the most important pillar of them all, risk management. This is where you take back control. See, a 401k investor just sits there and takes whatever the market dishes out. But an active investor, someone with a risk management plan, they know exactly where their stop sign is. They have an exit strategy planned out before they even get into an investment.
This quote just perfectly captures the whole mindset. You can't control if the Titanic is going to hit an iceberg, but you can absolutely control whether you get on a ship that has enough lifeboats for everyone. A portfolio without an exit strategy is like a ship with no lifeboats. You're just betting it will never, ever sink.
Let me put it another way. Would you ever buy 100 houses and just say, if 5 of them burn down, no big deal, the other 95 will be fine? No way. You'd buy insurance on every single one of them. Risk management, that's the insurance for your portfolio. It's not optional. It should be non-negotiable.
So, how does this actually work in the real world? Let's look at this example from the source called theta targeting. Basically, you start treating your portfolio like a business that needs to generate income. You set a goal, let's say 1% of your account value per month. So on a $40,000 account, that's $400 a month you need to generate. Then, you use specific tools, like options, to basically engineer that income. Now, without getting too into the weeds, certain options lose value every single day just because time is passing. It's called theta decay. By strategically building a portfolio that takes advantage of this, you're not hoping for growth. You're actively engineering a predictable daily income stream. It's a total game changer. And all of this leads to the ultimate shift in mindset that this material is all about. You know, being rich is just having a big number on a piece of paper, a high net worth. And as we've seen, that can get cut in half overnight. But being wealthy, that's different. Being wealthy means your assets produce more cash flow than you need to live on. That is true independence. That's freedom from a job and freedom from the whims of the market. So we end right back where we started, with a question for you. The conventional path, the 401k paths, asks you to just be a passenger, to put your faith in hope and time and just go along for the ride. The alternative we've talked about today is a call to action. It's about being the pilot of your own financial life. And that's the choice, really. So when it comes to your future, are you content to just hope you get where you want to go? Or are you ready to take the controls?